Welcome to this explainer, where we're going to completely decode the IFRS conceptual framework. Now, I know exactly what you might be thinking. Accounting standards can sometimes feel, well, a little bit dry. But today, we're going to transform those rules into the intuitive, universal grammar of business. Think of financial reporting as way more than just numbers on a page. It's really a dynamic language used to tell the exact story of a company's health. And we absolutely need this grammar. Because without it, everyone involved, from the daily managers to the outside investors, is essentially flying blind. Without a shared set of rules, reading a financial statement would be like trying to read a book where every single chapter is written in a completely different, totally made-up language.
Now, before we dive into the financial deep end, let's just take a quick step back and establish what we actually mean when we talk about a framework of concepts. A concept is simply a general idea derived from specific occurrences. It gives us a logical starting point. Honestly, you can think of a concept in accounting a lot like gravity in physics. It's the underlying truth that governs how everything else behaves, well, before you ever sit down to write out a single equation. It's that foundational logic that helps us categorize the incredibly messy, complex, day-to-day reality of running a business into really clear, organized financial ideas.
So the International Financial Reporting Standards, or IFRS for short, use this conceptual framework as their absolute foundation. It provides the basis to recognize, measure, and report financial events fairly and consistently. But you might be wondering, why do we need such a rigorous global foundation? Well, imagine a company in Japan trying to merge with a company in Brazil, all while seeking investment from a bank in London. The IFRS framework provides the universal translation for all of them. It's the starting point for determining how any transaction should be accounted for, ensuring that practices and principles are applied consistently, no matter where in the world you happen to operate. To break this all down, we've got 4 quick parts for you today: the accounting rulebook, quality over quantity, defining your assets, and finally, the balancing act. All right, part 1, the accounting rulebook, or as I like to call it, the blueprint of business. Let's establish the foundation. The entire conceptual framework is built on some absolute, non-negotiable core assumptions, just to make sure all our financial grammar is applied consistently. Let's look at 2 major ones to see what they actually mean in practice. First up is the going concern concept. This is basically the assumption that the business is going to continue operating indefinitely. We're assuming it won't just close its doors tomorrow. And this dramatically changes things. Because think about it, if you knew you were going bankrupt tomorrow, a $100,000 piece of factory machinery is suddenly only worth its immediate scrap value. Second is the accrual basis. This means we record transactions when the actual economic event occurs, like when the handshake happens and the goods are delivered, not when the cash eventually clears your bank account. Combine these with the double entry principle, and you've got a robust, totally reliable system for tracking every single economic event. Moving right along to part 2, quality over quantity, which is essentially our accounting style guide. Because let's be honest, not all data is good data, right? Financial information must pass a really rigorous quality filter. According to the framework, your info must fundamentally be 2 things: relevant and a faithful representation. So what does that actually mean? Well, relevance asks, does this information actually change a decision an investor or manager is about to make? If it doesn't matter, just don't clutter the report with it. Faithful representation asks, is this the unvarnished truth without any spin? It has to be complete, neutral, and totally free from error. Once you have those 2 fundamental traits locked down, they're enhanced by 4 more characteristics. The information should be comparable year over year, verifiable by independent observers, timely enough to actually act on, and, crucially, understandable. If your financial reports aren't hitting these markers, you really aren't speaking the language properly.
Okay, part 3, defining your assets. This is where we get into the absolute core vocabulary of financial statements.
You know, in everyday conversation, we casually throw the word asset around all the time. We might say a great employee is an asset or a really cool brand name, but the IFRS framework defines an asset incredibly precisely. It is a present economic resource controlled by the entity resulting from a past event. And trust me, every single word in that sentence carries a lot of weight. Let's unpack that heavy definition into 3 simple, logical steps. Step 1, an economic resource means it has to have the right or the potential to produce economic benefit. That means bringing in cash or maybe avoiding a cash outflow down the road. Step 2, control. You must have the present ability to direct the use of that resource and grab the benefits that flow from it. And step 3, the past event. The transaction or event that actually gave you this control must have already happened. And here is the absolutely critical takeaway for you. If even one of these steps is missing, no way, you absolutely cannot legally record it as an asset under IFRS. It is quite literally an all or nothing rule.
To put that in perspective, let's apply this to the real world. Think about your physical rights over an enormous item like an excavator. Does it have the potential to produce economic benefit? For sure, it digs holes that you get paid for. Do you have the ability to direct its use? Yes, you own the keys, you decide which construction site it goes to. Did a past transaction happen? Yep, you signed the paperwork and bought the thing. So it clearly fits the exact definition of a controlled resource.
But here's a fun curveball to consider. Physical items are super easy. What about trade receivables? Does a customer's promise to pay you later for goods you sold them on credit actually count as something you currently own?
Well, if we apply our strict grammar rules, the answer is a resounding yes. A trade receivable is absolutely an asset. And honestly, this is the sheer power of the conceptual framework. It takes a totally invisible concept like credit and gives it literal physical weight on a balance sheet. It's a present economic right. Specifically, you control a right related to the obligation of another party to hand you cash. It's due to a past event, which was the credit sale itself, so it perfectly fits all the criteria even without being a physical object you can hold in your hands.
Now flip the coin, and we hit liabilities. A liability is an unavoidable duty or responsibility. The framework defines it as a present obligation of the business to transfer an economic resource as a result of past events. Think about taking out a standard bank loan. The past event is super simple. You received cash from the bank. Because of that, you now have a present obligation, an unavoidable duty to pay that money back over time. You literally have no practical ability to avoid giving up your resources in the future. You are locked in. Which brings us to our final section, Part 4, the balancing act. Income versus expenses. Let's put all this vocabulary together for the grand finale.
Okay, so we've got our assets and liabilities. Now, how do they actually change over time? Notice the perfect parallel grammar between the two here. Income is defined as increases in your assets or decreases in your liabilities that ultimately results in an increase in equity. Expenses do the exact opposite. They are decreases in assets or increases in liabilities that result in a decrease in your equity. Now, here's a really crucial insight to remember. Both of these definitions specifically exclude contributions from or distributions to the actual owners of the business. Why? Well, because an owner injecting $100,000 of their own personal savings into the company checking account doesn't mean the business itself actually earned a profit. All of these dynamic elements, the income and the expenses, flow directly straight into your statement of profit or loss. You can think of the statement of profit or loss kind of like a movie of your business playing out over the course of an entire year. It shows the active flow of the grammar we just learned, capturing the ongoing dynamic changes in your business's financial health, giving you a crystal clear picture of performance over that specific period of time. So, the big payoff here, this entire conceptual framework, all of these specific definitions and qualitative rules culminates in the absolute holy grail of all global accounting, the accounting equation. Assets equal equity plus liabilities. Think of this as the ultimate set of scales. It tells us that every single resource a business controls, the assets, must have a source. Where did it come from? It was either borrowed from outside creditors, which are your liabilities, or it's owned outright by the shareholders, which is your equity. The scales literally must always balance perfectly. And if you just rearrange that grammar a little bit, you get equity equals assets minus liabilities. And wow, is this revealing? It means equity isn't just some arbitrary, abstract number. It is the residual interest. It is essentially the true net worth of the business. If you were to go out and sell off every single asset your company owns today and use that cash to pay off every single debt and liability you owed others, equity is exactly that pile of cash left sitting on the table for the owners. Which leaves us with a really critical question to chew on today. By fully understanding the IFRS conceptual framework, you're no longer just staring blankly at numbers, you are now completely fluent in the language of business. So, if financial reporting is truly the grammar of translating past events into present resources and future obligations, what story is your business actually telling?